Sonthalia joining us this morning, Director and Chief Investment Officer at MK Investment Managers. Manish, very good morning to you. What do you look at when you see the screen today? I know we are all seeing the sea of red, but I'm wondering what you are seeing. In the sense, are you seeing any opportunities there? Are you seeing more turbulence ahead?
So, I think what we are observing is that there is a first sign of capitulation that is happening in the markets. They started on Friday, and today it's a continuation of that. So I think it has all got to do with all known figures, known reasons. There is nothing out of the ordinary which is happening. It is to do with your currency depreciation. It is to do with your weak earnings. It is to do with your regime change in the US. It is to do with uncertainties around the budget. So I think, the overconfidence in the broader markets that everybody had, that's getting shaken at the margin, and that is the repercussion that we are seeing. Fundamentally, we all knew that mid caps and small caps are trading at 1.5 times standard deviation away from mean. And even in the past, whenever we had euphoric times like the Lehman crisis, 2013, 17, the P multiples on the broader markets have been significantly higher than what we are trading currently. So it's just a correction. Markets need a reason to correct, and probably these uncertain times are what is providing them that reason. Markets can go down another 5 to 7%. I don't see markets going down below that because I am just building in a 10 to 12% EPS growth and 18 P multiple on Nifty 50, and that will give me a level of around 22.5. We are already at 23.2, so another 700 points, 1,000 points, that is 5%. So that's all that I'm looking at. I don't see the markets falling below 22,000 and sustaining below 22,000 for a long period of time.
Manish, just good morning, Neeraj here. That's valid points, but just follow up there. If indeed the markets were to either correct that much or less, but stay in a sideways to a downward zone, what's the quantum of correction at the broader end of the spectrum? Because like you said, they were extended, yes, but it's also true that some of the best earnings growth stories are turning out not in the Nifty, but at the broader end of the spectrum, right?
Correct. I agree with you, but please understand, Neeraj, that I don't see a market shaping a V-shaped recovery. Even if the markets were to fall to those levels and was to recover, and they will recover in the second half of calendar 25, that's the base case assumption. But it's not going to be a V-shaped recovery. It's going to be a very gradual recovery based on policy initiatives, based on what we are seeing in emerging markets by the Mr. President of US and all of that. I agree with your point that some of the earnings stories in the broader markets are very, very good, and Indian markets have become very broad and very deep. But again, I go back to the same formula that if you are buying something with more than 3 PEG, these are basically playing to a lot of perfection, so to speak, as far as the earnings growth and the P multiple sustainability is concerned. So that is the major problem. If a company is growing at 30-40%, you can't trade at more than 100 P. So 30-40% in the broader market context is very good when the Nifty EPS is to be 10 to 12%. But if your valuation multiples are that high, and even those prices won't sustain. So that's the whole problem, that some of the known stories in the broader markets are so well known and so overconfidently bought that valuation is thrown to the winds, and that is the problem.
Now, Manish, with the kind of correction we've seen, are valuations looking attractive in any pocket to you?
So, see, the whole thing is that, I believe that calendar year 25 is going to be thematic from the point of view of the currency depreciation. I think, our central bank is not going to defend the rupee that, strongly as we have done in the past, and rupee will find its own level. And some of the sectors which benefits from rupee depreciation are very palatable even at current valuations, and if the markets were to correct another 5%, they would become even more attractive because you will have top line and bottom line get it aided by your current the amount of quantum of currency depreciation, and probably they would all fit into the parameter of less than 3 PEG or anywhere between 1 and 2 PEG. I think those are the pockets which will relatively outperform when you compare it to the other domestic themes or import-related themes, which are going to be headwinded as the currency depreciates.
Okay. Manish, one last question really. If you're getting in, and I'm sure you must be getting in fresh inflows, but though actually the market may be shaky right now, are you putting them to work currently in stories which might be good growth stories, or are you biding your time?
No, so I think we have always maintained that remaining fully invested because the benchmark remains fully invested. Of course, these are knee-jerk times. Maybe for a very short period you could take some anemic cash calls, but that's about it. I think it is all well known that the margin of safety is in the large caps, not in the broader market. Generally, there are good stories even in the broader markets, but I think the island of safety that one can assume today in current uncertain times is basically the large caps. Within the large caps, the currency depreciation themes would be good relative places to hide. Now that we are just approaching the earnings season, I think the fresh allocations that we are getting are moving out of high betas, somewhat high beta names, even though earnings growth, etc., are perfectly okay, and getting into currency depreciation themes and more so in the large caps.
Any sort of directionally clear choices there, Manish, in terms of sectors, if nothing else?
Choice. IT is a clear choice. Banking, because of the very beaten down valuation, they are a clear choice. Platform companies are a clear choice because you'll see significant earnings growth and valuations have corrected. And capital market related themes are perfect choices, because you will see the whole point is that the financial sector is driving the real sector, and within the financial sector, the tilt is moving away from debt to equities. So in these sort of correction times, you could be very well positioned from the medium-term point of view when you buy into capital market entities. I would relatively stay away from themes like real estate, renewables, power, capital goods, railways, defense. These are some high beta themes, extended valuations with the growth they are exhibiting, and too much of overconfidence and over-ownership. So, relatively stay underweight on these spaces. And obviously consumer, the consumer is a stressed lot, both in the staples as well as the discretionary side. And in the middle of the earnings season, we'll see a lot of positive and negative surprises in the consumer discretionary and staple space. So again, that is a space which I would be relatively cautious about.
Okay, thank you so much for that, Manish. Manish Sonthalia.